Federal regulators have seized Silicon Valley Bank.
Silicon Valley Bank is the largest failure of a financial institution.
Is the largest bank to fail.
Within a span of just 48 hours, the United States has witnessed collapse of two major banks. The first was the shutting down of the Silicon Valley Bank, and next was the turn of Signature Bank. The Signature Bank's fail is the third largest banking disaster in US history after Washington Mutual, which collapsed during the 2008 financial crisis, and the SVB's collapse. With these failures, the financial market is tense and talks of recession and contagion are really spooking everyone. There are two questions that's on everyone's mind. First, why did these two banks fail? And second, what are the chances of financial contagion after these two major failures? In this video, we will try to tell you answers to these two questions that are making everyone jittery. But before that, don't forget to like, share and subscribe to Oneindia. Let's first understand why Silicon Valley Bank failed. There are two main reasons for it. First, SVB was hit hard by the downturn in technology stocks over the past year, and second, because of the Federal Reserve's aggressive plan to increase interest rates to combat inflation. Silicon Valley Bank had bought billions of dollars worth of bonds over the past couple of years using customers' deposits as a typical bank would normally operate. These investments are typically safe, but their value fell because they paid lower interest rates than what a comparable bond would pay if issued in today's higher interest rate environment. But Silicon Valley's customers were largely startups and other tech-centric companies who needed more and more cash over the past year. Besides, the venture capital funding was drying up. Companies were not able to get additional rounds of funding and therefore had to tap their existing funds, which were often deposited with Silicon Valley Bank. So, Silicon Valley customers started withdrawing their deposits. Initially, that was not a major concern, but the withdrawals forced the bank to start selling its own assets to meet those requests. And because SVB's customers were largely businesses and the wealthy, they were more fearful of a bank failure since the deposits were over $250,000, which is the government-imposed limit on deposit insurance. That effectively required SVB to sell those typically safe bonds at a loss. And those losses added up to the point that Silicon Valley Bank became effectively insolvent. This incident led to wiping out of more than $100 billion in market value from US just last week. Now, let's understand what happened with the Signature Bank. Signature was opened in 2001 and it had pitched itself to businesses and individuals as an alternative to big banks. It prided itself on its customer service and lack of bureaucratic red tape. After the financial crisis, Signature grew rapidly and became investors' favorite. In 2018, it hired bankers specializing in crypto as part of an effort to branch out beyond commercial real estate. Other banks were very reluctant to take on crypto customers, and so Signature became one of the crypto market's leading banks. That focus on crypto companies helped the bank more than double its deposits in just 2 years. In early 2022, around 27% of its deposits were from its digital asset clients. The bank's exposure to crypto became a problem as the years passed by. A market rout that deepened after last November's collapse of the crypto exchange, FTX, drained billions of dollars in deposits. Late last year, Signature had said it was dialing back on crypto and parting ways with some crypto clients. It had also cut ties with the international business of Binance, the biggest crypto exchange. But these moves failed to calm investors. Signature was also reeling from a bet on crypto banking that floundered after the sector imploded and banking regulators cracked down on lenders' exposure to digital assets. Like Silicon Valley Bank, Signature also had relied very heavily on deposits too big for the FDIC insurance. Now the question that remains to be answered is what are the chances of contagion and recession due to these two failures? As of this moment, experts say that the idea that these two failures could have a domino effect worldwide is a bit far-fetched. That is because up to 95% of investments in these two banks were of niche category customers, and it is not likely to affect the broad banking sector. Other banks are far more diversified across multiple industries, customer bases, and geographies. In fact, the most recent round of stress tests by the US Federal Reserve of the largest banks and financial institutions had showed that all of them would survive a deep recession and a significant rise in unemployment. So at this moment, the risk of contagion and recession due to this is very minimal. We hope you would like this new video. Thank you so much for watching.